Last week, the European Central Bank cut interest rates for the first time since 2019, moving the rate paid on bank deposits by a quarter point from 4 to 3.75%. ECB President Christine Lagarde referred to there being a strong likelihood that this decision marks the beginning of a dialing back of rates from their all-time high, albeit has cautioned that it may not be a linear declining path from here, and further moves will have to depend on the data. The ECB decision comes before any central bank action to ease on interest rates from either the UK or the US, but recent data has shown a return to the slow trend lower in inflationary pressures in both countries. Given these events, it was a timely juncture to catch up with one of the most experienced bond fund managers in the UK. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe to be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Richard Woolnough from M&G. Richard is one of the most experienced bond fund managers in the UK today. Starting his financial career at Lloyds Merchant Bank in 1985, he later became a fund manager at Old Mutual in 1995 before moving to M&G in 2004 to launch two strategies, the corporate bond and strategic corporate bond funds. These were closely followed by a third, more flexible mandate, the Optimal Income Fund, in 2006. And this suite of three funds, Richard has managed and co-managed through to the present day. This was clearly an interesting time to speak to Richard, and we hope you enjoy the conversation. And please do get in touch if you'd like any more details on any of the topics discussed in this episode. Richard, good morning. How are you doing today?
Very well, thank you. Good morning.
So, Richard, we got a kind of standard opening question to these discussions, which we ask all of our speakers, and it attempts to get a bit of an insight into you, your kind of typical working week, or perhaps what you've been working on recently. So we've been asking if there's any kind of anecdotes from perhaps a recent meeting or even just an interesting article or book that you've come across that you can maybe share.
I've had a series of meetings with sort of UK-based clients and sort of in a similar sort of genre to you or that kind of area. It's quite interesting, the conversation we're having about that, about how they've sort of gone away for a long period of time. They didn't see value in where interest rates were, and now they're exploring how to invest money for clients again. I think that's interesting. So it's conversations with people who sort of got it right by removing the risk from their portfolio and not taking an index approach, and they're starting to put that duration risk back in. So that is a general theme. People are sort of warming to the idea that we're near the peak of the rates and the risk reward is getting more positive. And I sort of tend to agree with that. Sometimes I'm maybe a little bit more bullish than they are.
Yeah, no, absolutely. There's certainly a lot more interest in this side of things than perhaps previously. So, Richard, maybe to start the kind of main body of the conversation, I wondered if I could perhaps ask you to kind of lay out your kind of broad view on the inflation outlook and what you expect of kind of monetary policy action from here, if I may. I know it's a big topic, but if you could kind of lay out your kind of broad thoughts on inflation at the moment.
Yes, obviously we've had a huge period of very, very high inflation, and it's a function of a number of things. The legacy of the response to COVID, the events in Ukraine. It is working with a lag. Monetary policy works with a lag. So the inflation we have now is a function of the monetary policy we had in the past, too easy monetary policy, whether that be conventional monetary policy for low interest rates or an area I'm sort of more of a differentiator on, the fact they printed lots of money sort of increases inflation. They're now obviously with a lag, rates are slowly slowing the economy down. You can see unemployment picking up. Traditional lead indicators of a weaker economy in the US, things like the quits rate, people don't quit jobs because it's harder to get a new job vacancies versus the size of the labor market, size of the unemployed. All these things are sort of pointing towards monetary policy working. So as monetary policy works and inflation comes through. And the problem is there's lots of lags in all this. So, the wages themselves lag the real economy. The real economy lags interest rates. So quite often, inflation will be sticky. But when it was sticky and low, people don't call it sticky. People call it benign. But it takes a while for those prices to adjust up. And obviously with the lag now, it's sticky and seen as not benign. And also within that as well, especially in the US, which is the lead driver of capital markets and bond markets, I mean, the big question is whether inflation, the measurement of inflation is sticky, because they have a big sort of house price element in there, which is very slow moving as well. And historically is underreports inflation in the bull market, overreports inflation in the bear market in terms of inflation risk. And whether it's that measurement that's sticky or actually the real inflation is sticky. So we sort of sit there, and I think the big sort of dividing range we have is that a lot of the inflation hasn't been caused by cutting interest rates. For example, Europe had very high inflation, and it was quite interesting this week. The ECB announced the first rate cut since 2019. They didn't cut rates in 2020 because there wasn't room to cut them. So they got the inflation by printing money, and destroying that money gets inflation under control. And I think we have a blog coming out this week on the Bond Vigilante site, which talks about how monetary policy affects inflation. So maybe that's something, if somebody cares about looking at that, have a different view of what other things can happen, they can look at. So we're sort of quite, think the inflation will come under control. And the good thing is as a political message, or as a central banker, or as a government, the desire to kill inflation seems to be really high, which is good news for bonds. If you had a world where people didn't care about inflation and care more about employment, that'd be bad news for bonds.
So look out for that blog post. And I know you've provided a chart in a number of your presentations about that money supply growth, and that being the kind of indicator to inflation. If any listeners want to kind of have a look at that chart, we'll happily send that along, or maybe provide a bit of a link to it in the description. But I wonder if we can maybe turn to the kind of economic activity side of the equation. It's been a period where the consumer's surprised quite a lot of people in its kind of resilience, and you kind of referred to that kind of lag effect. But do you expect that kind of strength in the consumer to persist, or do you think there will be cracks that appear as that lagged effect goes through?
I think that the consumer is affected in different ways. And again, this is one of the sort of difficulties we face, is that traditional monetary policy assumes we're all borrowers, because that's what we used to be after First World and Second World War. And obviously, by definition now, there are many borrowers and many savers. Putting interest rates up hurts a borrower and gives income to a saver. And cutting interest rates increases income for a borrower and reduces income for a saver. So it is a difficult environment to work through about how the transmission mechanism works down there and how it affects consumers. I think unemployment is slowly starting to pick up. So I think that the consumer is sort of always quite resilient. And it tends to be things like the things that move GDP around tend to be car sales and housing market. So if the housing market isn't stimulated, and if people don't have those big discretionary spends about car sales, then the economy might be a bit weaker. But we're starting from a relatively healthy point. If we go from 7% unemployment to 8% unemployment, it's probably a lot more damaging for credit in the economy. If you go from 3.5 to 4.5, then obviously it's painful, but it's obviously not damaging to the economy as a whole as much. So I think the consumer can be resilient. We had the view that inflation can come down because of destroying money, not by causing a recession. But if the central banks continue to pursue an overly tight monetary policy, it will result in an economic slowdown, and that will result in consumer confidence going lower, consumer spending going lower. Monetary policy works. If they're too tight, then they will destroy the consumer. If they're too easy, they will result in too much consumption. It's a question of where the central bank gets with that mistake and how it adjusts from a tight monetary policy, which we still have, to an easier monetary policy.
Richard, if we may, can we move on to the kind of the opportunity set in your kind of investable universe? And I recently listened into a presentation you did not too long ago, which kind of coincided with your 20th anniversary, I think, running some of the early strategies that you launched. And one of the key takeaways for me, at least, from that session was that the kind of the investment process has remained pretty consistent, albeit you've gone through some pretty major market events over that 20 years. So I wondered if you could maybe touch to that kind of valuation framework you've got, and maybe give us a sense of kind of what the opportunity is at the moment.
Yeah, I think the first thing we always think about duration, where are interest rates going, which is a function of economic growth, primarily inflation. And so the majority of the time that we've been running the funds, in that 20-year period, there's really only been one period, which is 2007 and into 2008, where we embraced that risk. Let's say the benchmark would move 5% if interest rates move 1%. We only really wanted to have more risk and be over that kind of duration measure in that period of time. And we're now back there again. So for me, the risk rewards are quite compelling. When yields were near zero, yields can't go through zero. So irrespective of the conversation about economics, valuation, politics, what's going on in the world, if you've got an asset class that can't really trade through zero and is near zero, it's not attractive as a risk reward proposition. And now we're up towards 5% in UK gilts, and long gilts about 4.75% this week. And you're getting near to the ceiling. So what's your downside risk? So irrespective of what the views about the economy and everything else is, where do you want to be maximum in? And so if you think about it, if you got to 6% interest rates, I say another point sell-off, if you got to 6% interest rates, you'd have real yields of 4%. That's enough to slow the economy, in my opinion. Real yields of 4% are enough to get people to buy bonds. And so you're very, very near the ceiling. So the main thing that's really changed from pre-COVID, say 1920 to now, is we've gone for a period where it's very difficult to find a reason to own a bond, to now being it's very difficult to find a reason not to own a bond. And the risk reward is a lot more compelling. And then if you think inflation is out of control, the economy is going to boom, then obviously you might think you need to change your valuation framework. If you think like we do, that the inflation will be controlled, monetary policy works to the lag, you don't need to change your valuation framework, and obviously bonds become very attractive. So that's where we are. And in our funds, the UK funds, generally speaking, if our risk budget is, if the index is 5 and the maximum we could go to is 8, the shortest we can be is 2 in terms of those risk measures. We're using half of that. We're at 6.5 now, so we're 50% in. And given most of the time that we run the funds, we've been 100% out. And it is a valuation theme. We are a valuation fund. It's a general thing around M&G being valuation based. And our valuation framework says that neutral bond yield should be somewhere in about 4. If we were to rephase that valuation framework, it would actually be to say maybe long-term yields should be lower. I mean, the best way to think about this is we think neutral rates should be 4 because it's 2% inflation, 2% GDP growth. When I started, neutral rates in the UK would have been 8 because it would be 4% inflation, 4% GDP growth. So if we just think where's inflation and GDP growth going to be, are we a suboptimal in terms of GDP growth as the population ages? It might push us to be where we were pre-COVID, of neutral rates being somewhere near 3, 3.5, as opposed to being 4. So we're always examining that big structural position. And so for us, we find bonds more attractive in the past. And I think that's something that people are finding themselves. And their struggle is to work out to buy a short-dated bond or a long-dated bond. But obviously they are finding, that cash alternate attractive again.
No, thank you for that. Yeah, that 2+2 I find really useful in kind of framing things. I mean, as you say, yields have obviously done what they've done, but I mean, one of the the features of the recent move is that kind of proportion of credit spreads, so that the kind of the return premium above the government yield has contracted a bit over the last couple of years. I wondered if I wouldn't mind kind of hearing your thoughts on that. What are the implications of that with how you're positioning portfolios? And if I may, just a kind of as a second part of that question, I wouldn't mind hearing how you, given that has happened and what yields have done, how you view the attractions of UK credit within a diversified portfolio, that kind of equity bonds kind of debate, which kind of always ebbs and flows a bit.
I mean, it's sort of like the mirror image of the conversation about duration. We spent sort of a majority of the life of the fund not owning duration. We spent the majority of the life of the fund being long credit. In 06, 07, we were underweight credit risk, overweight duration risk, because we thought the market wasn't priced for recession correctly, which means you don't want to take the credit risk and you do want to take the duration risk. And this is before, obviously, the market did blow up. So since then, we've generally speaking, you get a nice tailwind from credit. You always get overcompensated for credit, even when it's at fair value, you get overcompensated. And being an active manager, there are many ways to add value within that as well, which is a lot easier to do, a lot more opportunities than you get, let's say, doing the government bond, simple government bond fund. So obviously we've gone for a whole period of owning quite a lot of credit risk. But what's happened of late is the market's at fair value in generally around the world. But the UK market is slightly dear. So, there's some distortions going on where the long-dated the corporate bond market is quite expensive versus long-dated gilts. We think 5 years and 10 years and short-dated corporates provide value. But we find that long-dated corporate bonds are very tight historically versus where governments trade. And as such, we're sort of underweight credit risk. It's very focused on those long-duration instruments. And that gives us like underweight credit. So global credit is around about fair value. Many UK credits, the short end are around about fair value, but some of the longer dated bonds aren't. And that's due to the relative supply. There's been very limited supply of corporate bonds, and pension funds want to buy them for the all-in yield. And obviously we know there's a huge supply of gilts. So there's a huge supply of gilts and a limited supply of corporate bonds. The spread will tighten. And hopefully at some point that should turn as one of the things driving the supply of gilts is the quantitative tightening, where the Bank of England bought lots of gilts, and therefore by definition, drove the price higher than otherwise it would be if they weren't in the market. And now obviously they're still in the process of selling gilts, and combined with the big budget deficits we have post-Ukraine, that means there's lots of supply. We're waiting to see post the election, but traditionally, incoming governments, where it's a change from one party to the other, they tend to be fiscally prudent over those years, whether that be the austerity of Cameron, whether it be the fiscal prudence of Blair. And we'll wait to see, presumably, what Starmer's going to do. In terms of what we'll have to find a catchphrase. I have to have a little think and see. I'm sure the press will come up with him.
I'm sure they will, yeah. Plenty of catchphrases.
It was prudence from Brown, wasn't it? Fiscal prudence from Brown. It was austerity, well, you could argue. But they call it fiscal prudence, depends on your political point of view. And we'll see what Starmer and his team do, because one has to presume that, they're preparing for government.
So, I mean, you referred to the kind of ECB rate cut that we had recently. So far, we've seen a small number of central banks initiate their kind of first cuts this cycle. I think we had Sweden, Switzerland, Canada, and now the ECB. But I mean, the US seem to have got a bit kind of stickier inflation prints more recently, and obviously nothing from the UK yet. I don't know where your kind of your portfolios and your focus is, but I wonder if there are factors at play that you think might lead to kind of near-term divergence in that kind of regional policy.
Well, I think you've got sort of near-term noise. It'd be very hard for, you've got the US election thing, so maybe the Fed keep rates high for longer. Can can the Bank of England cut rates ahead of the election and the next meeting becomes a little bit more difficult, because it's seen as political, as they might as well wait. And then there might be something radical the new government comes and does, which means they might have to reverse policy or do something even more dramatic, so they can sit on their hands and wait. I think the main key really is not when they cut, but how much they need to cut by to solve the economy. So the economy does get weak, and we do need to stimulate through money policy again. Where do they need to cut to? Do they need to cut them by a quarter to do 1 point every year? Is that going to have any economic effect? Or do they need to do a point a quarter? I don't know. It depends on the state of the economy and how tight they've been, and if they've been too tight for too long. I mean, generally speaking, central banks, indicate what they're going to do. So you could argue that in the code coming out of COVID, they said we're lower for longer, too long. Now they're higher for longer. Will it be too long? And so the more that the monetary system gets, the more harder the economy is, the more they have to react to correct the problem. And it's very difficult for them because they've never been through this before. They never had this COVID situation before. They never had the policy response to that. And they've never had, printing this much money and then destroying this much money before. You talked earlier about countries that have done this. I think the prime example from noticing this is, let's say, a European country. I mean, the example you gave there, which is Sweden. So Sweden have cut rates, but then their central bank was posed with less of a problem. They took a different public policy issue around COVID, very different policy during the time, where they did more isolation and less lockdown. They continued operating, which meant they printed less money. It meant they had less inflation, and therefore they're at a different part of solving their inflation problem than we are. And so the countries that really had to acted very aggressively to help them through COVID have obviously now got to, solve the benefit they gave there. They've got to work out how to go through that. Most extreme example is somewhere like, I know it's probably a bit too extreme, but somewhere like China, which had a completely different COVID policy, and they didn't print money to this because they could operate in their state system as a closed economy. And they have record low bond yields. They have low inflation. They're in a very different place to us. And so you can see that emerging markets couldn't afford to do all these policies. Therefore, they had less inflation. We could afford to do these policies and took the actions that we did. And therefore, we need to sort these things out afterwards. And that's been the difficulty for the Bank of England. Even when they started, thinking about tightening policy, you never knew if there was going to be another lockdown. So we forget that now, but it was heavily discussed at the time. And so, they had to set the appropriate economic policy for the public situation, the policy decisions that were taken. It's when they do it, how much they need to do it by. And the one thing that's really changed from 20 years ago, when I launched the fund, we would talk about rates theoretically could go to zero. We never thought they'd go to zero. They might go to 1 or 2 temporarily. But now the experience we've had, we've had to have rates at zero for long periods of time, or near zero in the case of Europe for a long period of time. So obviously, the upside, that risk reward in bonds, the theoretical upside is actually quite large. The actual upside is quite large, whereas before, when yields were these levels before in 06, 07, it was very much a theoretical argument.
There's some interesting points in there. Thank you for that. Richard, my last question is a touch-off piece, but hopefully not too much. Is one that we've had a number of discussions with equity managers, a number of actually UK equity managers on this series, talking about kind of how we could or should reinvigorate the UK equity market with kind of policy change, given what's been a real period of kind of shrinkage in the UK market. I wondered if you had any thoughts on that from the perspective of a bond fund manager, or perhaps kind of how you, if we look forward to the next 20 years of running a bond portfolio, how you think the bond market may evolve over the medium to long term.
Well, I suppose, by definition, when you ask this question, they're all looking for ways to increase their potential, their terms of trade. They're all looking, I want a tax break, I want a listing, I want this, I want some bias towards investing in UK companies. So understandably, as an industry lobby, you're going to talk your way. And obviously, as a house, we care about that, and we care about bond markets and listing of equities. But it's part of the globalization that's going on. The reason we had such a large UK equity market is because we were a large part of the world economy, and we were a large part of capital raising and trade. We're now a smaller part, and therefore the UK equity market will shrink over time. It will become smaller, and innovation will go elsewhere. And if the capital markets are big in the US, so you can raise the finance to acquire something or raise the finance to IPO, that you will go to your cheapest form and largest form of finance. And therefore, this will potentially continue. So I don't think it's one of these things that you get, and then you get obviously quite heavy investor concentration, very much a sector bias. And what happens is that clients see this and they adapt, and they go from being, oh, I'm a UK focused, I want to invest internationally. We do that as well. I mean, some of our funds can buy foreign currencies and hedge back into sterling, so we can buy bonds that aren't available in sterling, and then hedge back into sterling to get access to that capital. I think that's where you have to be look out there and be multi-global. So, and do you think about other economies that have gone through this? In my world, it's the Swiss bond market. The Swiss bond market used to be a very big bond market years and years ago, because that's where all the savers were for various tax reasons and things like that. So it's quite a big Swiss bond market, corporate bond market. Now it doesn't exist anymore because obviously, the investors are not there, haven't got the same sort of tax-driven, domestic agenda that the Swiss investors or the Swiss money had. So, I think it's natural. It's natural for a stock market to sort of rise and fall. It's natural for these things to change over time. And the one thing you don't want to do is do things that make it difficult to be here. So I think the only sort of challenge is preventing things that maybe a company might decide to delist from here and go somewhere else because the regime is changed or the regulatory changes or as a tax or something like that. So, but that's what the capital will move from one place to another place. So I think really we've got to try and encourage it, try and keep it. But, we've got to recognize the reality of a global world. Why should a population of 60 million, even though those companies are international, got foreign earnings, why should we have this big market? We have things to drive that. We have a skill set to trade in it. We have a skill set in hedge funds to do things. We have a skill set in fund managers to do things. So we still benefit from the world stock markets. We still, financial services industry is still very good for the economy. But the fact that you're trading things that are listed in New York or Tokyo or wherever they may be, is still a benefit to the country. The fact that we're not trading ones that are electronically listed here is not something you should get too worked up about, I don't think.
Yeah, sure. No, interesting to hear your thoughts on that. Richard, thank you so much for sparing some time. It's been really interesting talking to you. Thank you.
Thank you very much, and have a good rest of the summer.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.